In an ocean of sensational headlines and personalities and forecasts, I've always found you to be very pragmatic in your outlook.
First of all, because we have these extraordinarily overvalued assets. Again, the bedrock of the global financial system is the debt market.
Simultaneously, based on what I just said about my expectation of just increased volatility for the next years, I keep on coming back to a place of, the best asset in my business right now is going to be agility, right? Agility and simplicity. And I don't know what the next 3-4 years are going to look like. So what do I want my business to be? Welcome to the Jay Martin Show, where we are hunting for more personal sovereignty because nobody can tell you what's going to happen next year, let alone tomorrow. So the smartest thing that we can do with our minds and our money is become our own uncorrelated asset, not tied to or dependent on the performance of anything that we don't control. We captain our own ship around here. Now, my guest today is Danielle Park. She's a financial author, a lawyer, a portfolio manager, and founder of Venable Park Investment Counsel. Danielle manages the money of very wealthy individuals. And the reason I love talking to people who manage the money of very wealthy individuals is so that I can learn what they're super scared of, what keeps them up at night, and what they're excited about. It helps me add context that I can apply to my own portfolio. Now, with Danielle today, we talked about a handful of things, including why she thinks the Fed is smart to raise rates, but why she thinks their timing is terrible, and therefore why they are not going to be able to stick to their guns. I also got her forecast on a variety of asset prices and her thoughts on inflation. I hope you enjoy this. If you do, I publish a weekly newsletter and I absolutely love writing it. There's a pinned comment right beneath this video where you can subscribe. I'd love to have you join the team. Now here is Danielle Park. Enjoy.
This is Jay Martin.
All right, so I'm back with Danielle Park. Welcome back, and thanks so much for coming back on the show.
My pleasure.
I'm looking forward to chatting with you because, in an ocean of sensational headlines and personalities and forecasts, I've always found you to be very pragmatic in your outlook, and I appreciate that. So I wanted to start today by saying, Danielle, with all the chaos eating every headline that we're seeing every day, what are you focused on? What are you paying attention to that you feel really matters?
Yeah, chaos is a good word, right? For what seems to be happening right now. But I think that when certainly the invasion of Ukraine has been a big shock to the system. And that's only been since February the 24th, right? It's funny how we adapt so quickly. We feel like, oh yeah, this has been going on for a long time. No, this is just in the last month. And coming at the end of a pandemic, like the superlatives here are incredible when you stack them up historically, right? Coming at the end of a 2-year pandemic where we had a great shock to the system in terms of demand that was driven by fiscal support, emergency programs, deferral of payments, and then central banks, the Fed cut something like 8% of easing between slashing the Fed funds rate at the start of the pandemic and then adding all the money to the balance sheet that they did through increased quantitative easing. So they had this massive liquidity infusion, which went primarily into financial markets and into consumer durable goods, which we saw this big jump in durable goods, which inflated again commodity demand. So we had these inflationary impacts that really came all of a sudden in rapid fire starting in early 2020. And that continued for the last couple of years, was starting to slow down. What we were looking at was a slowing economic outlook into 2022 before the Ukraine invasion. And that was a rate of change downturn in both the amount of consumption that was going on, just because it was basically surfeited. At some point, everyone's bought everything they possibly can. And now we're starting to see some movement back towards the office, some, need to commute again, that sort of thing, and less of that hyper focus on just migrating in one's abode, right? So you sort of had a natural pace of that couldn't go on forever anyway. And indeed, durable goods are things that last more than 3 years. And in fact, so the stuff people bought in the last couple of years are going to last a few years. So that had its natural kind of end coming. And then we get this big shock to the system in terms of the Ukraine invasion, which is primarily to do with the oil price and grains, right? Yeah. So this big leap in those two highly inflationary aspects. And indeed, we've seen that in other cycle peaks in terms of demand, which I think that we had coming into 2022. We see this kind of action in things like fossil fuels being a normal and predictable catalyst to get central banks back to a hiking mode in very quick order. I think the policy mistake has already, of course, been made, Jay. I'm sure you're well aware of this, just that last year when this consumption was so voracious, when people were spending their brains out, that's when, the tightening should have began.
Right.
But they've left it so that we're now almost fully through this economic cycle and they still haven't, they barely have started moving. And now with this spike in inflationary concerns, you've got a lot of stress on the consumer. Right, with all the debt, you've got a lot of stress on corporations because revenues were naturally starting to fall because the demand cycle had turned down. So you've got compressing revenues, just as you have the highest debt on corporations as a percentage of GDP that we've ever seen. And you had this anomalous period of extremely low rates. So once you get a sudden backup in rates, you've got now a rate shock on top of fuel, on top of a housing shock, on top of, a food shock. I mean, you really couldn't hit the consumer any harder than that. And so those things are really, as I say, I think we're already seeing it in all the consumer sentiment indicators. Like, University of Michigan consumer sentiment is the lowest it's been since past recessions already. And that's with housing still at these all-time highs and the stock market still, the overall average within not too much of its all-time peak. So even with high asset prices, you've got really bad consumer sentiment. And you're seeing that in ledger polls and various surveys that are being done of the consumer saying, yeah, wow, we're cutting. We've already cut this and that. We're not going to be eating out. We're not going to be traveling. We're really looking to pull in expenses. So I think that it's really going to sort of accelerate the downturn that had already started coming into this year.
And if that plays out the way you forecast it might, do you expect the Fed to then back off the rate hikes and try to undo what's happening? What's your expectation? Yes, you do. Okay.
I do. I think that this, I've been around a long time at this point. I remember this vividly in the May 2000 cycle. Right. The central bank, so now we're talking about an expectation of hiking 0.5 point in the next 3 meetings and getting the Fed funds rate above 2.5 by the end of the year, when they came into the year at 0.25. Okay, so talk about a heart attack, right? This is a, oh my goodness. And this is partly politically influenced, of course, coming into the midterms in the US, Biden's support at 40%, all-time lows, and politicians everywhere taking the heat, being blamed for shutdowns during the pandemic. I mean, there's a lot of negative sentiment. Again, consumers under a lot of pressure here. A lot of people are fed up. And so there's a lot of political anger being directed at incumbents, which again intensifies this expectation that someone should do something. Unfortunately, it's already been done. And what was done was this really throwing gasoline on the fire of consumption, which drove all this frenetic behavior, both in asset markets and in consumer goods and that sort of thing over the past couple of years. So what we have now is this hyper expectation that central banks should do something. So yes, they are saying, fine, we'll hike 0.5 point. The last time they hiked 0.5 point, it's amazing. The last time they actually had the nuts to hike 0.5 point was in May of 2000. And what they did at that point was then forecast they were going to continue to do that. In fact, that was the last hike of that cycle, Jay, because everything started to turn down. The Dow had already peaked, by the way, in December of 99. The S&P and the NASDAQ peaked already in March of 2000 before they did this 0.5 point hike. And by the fall, the commodity-centric TXX was falling out of bed and stocks went on to lose half over the next 2 years. They were back to slashing rates again by January of 2001. They cut by a half point because the economy had so clearly taken a downturn, and because of the asset markets that were just unraveling all around it. And so that's why I think that we're in a similar dynamic now. We've got a lot of overconfidence because asset prices have inflated so much. The flip side of that, of course, is that we're all that much more vulnerable, both as an economy, as financial markets, and as households and businesses that are levered off that.
I want to pull on that thread a little bit. When you say more vulnerable to what exactly? So I like how you put that in context, because more frequently I hear people compare today to the 1970s inflation cycle, right? And you pulled up a different example, being 2001, the attempted rate hike that the Fed was not able to follow through on, right? And to you, that's a more accurate parallel, maybe more accurate playbook of what might occur. So when you say, the economy is more vulnerable, exactly to what, Danielle, catches your attention?
So first of all, because we have these extraordinarily overvalued assets. Again, the bedrock of the global financial system is the debt market, essentially the bond market. It's much bigger than the stock market. And that market has been so grotesquely inflated through the last decade of ultra low rates, easy money policies, just pumping cash whenever there's any kind of slowdown that appears in consumption. So that's really inflated this asset class underneath the world economy. And then we've seen the levering off of that, right? So that's shown up in real estate bubbles in places like China, in places like Canada, in many developed economies. And you've also got this great over enthusiasm in things like the equity market, where it was primarily driven all by buybacks and multiple expansion, and very little to do with earnings per share growth. As the stock market has essentially doubled over the last decade, we've seen maybe a 30% increase in earnings per share, and that's with all these buybacks, right? So I guess what I'm saying is we have a demographic issue. We've talked about this before, which is fundamentally different than what we had in the 1970s when boomers were coming into household formation. We have a fundamentally different picture in terms of supply dynamics for the world's fossil fuel markets, which again were much more vulnerable and concentrated back in the 70s than they are today with the various players and producers. So there was that. We have a much more drive towards efficiency now, and a possibility of people actually moving to alternate modes of transportation as a service, electric vehicles, all these things that are really reducing the amount of growth for fossil fuels in the world. So again, oil has typically been the largest spike to drive these inflation cycles. And the typical response by central banks has always been, let's hike rates to contain this inflation. But as soon as they do that, of course, it's the triple whammy of the inflated commodity prices and then the rate shock that is the tipping point to get the economy finally into a recession. So, I find it quite ironic that we have this, you'll hear people talk about the fact they think households, and central banks do this, but I've heard others do it. Banks, economists love to do it. They look at, for example, let's take Canada, because we're notorious in this particular housing cycle. And we look at things like the household balance sheet, and people say, well, the household is so much more robust today because they have so much more equity than they had in other cycles. But why do they have that much more equity? Because there is that much more debt in the system, and because it is that much more overvalued. So those are the opposite of being indicia of strength. I see that excess leverage as indicia of vulnerability when you get an asset deflation cycle, which we've kicked the can on. It's begun and stopped now for the past decade. But at some point, you can't elongate that indefinitely. And I think that this particular tipping point is likely to have legs and continue for some time. And then it's going to be just as awesome on the way down as it has appeared on the way up, in the sense that the implosion of household equity will be much more dramatic this time, because we have that many more participants in housing with a lot of leverage. So I think that is the issue. Now, mortgage rates, it's awesome when you look at what's happened with the bond market just this month, right? Things like the 5-year bond yield are up more than 1% just this month alone, Jay, because of this rate shock environment that I'm talking about. And the bond market saying, all right, we hear you, central banks, you want to hike aggressively, fine. Boom, we just did it for you. Never mind doing it over the next 9 months. Boom, we've just done it for you. So now the 5-year mortgage rate, which is based on the 5-year treasury yield, has gone above 3.5%, could very much be above 4% by next week. And this all compares to like 1.4%, at the low of 2021.
That's right.
At the same time, of course, our housing market, the average home price was about $580 at the start of the pandemic. It's about $880 today. Mm-hmm. So if you do the math on the median home price and the rate change between 0.4 and 3.5, never mind 4, you're talking about mortgage payments that are about doubling.
That's right.
And that we're talking about in a matter of months.
And I can't recall the exact stat, but it was just yesterday I was reading about the percentage of Canadian mortgages that are variable rate. Right. And
it's about 35% overall. It's about 45% of the mortgages taken out in the last year are variable rate
in the last year.
Yeah. So obviously they don't float yet. They don't move higher till those actual rate hikes happen, right? Until the Feds actually do the hiking in the pipeline. And if they do the amount that they've telegraphed at this point, you could see the variable, rate move above 3% by year end. And so, a lot of those people now, historically, if you can float a rate and not lock in, you tend to have a lower interest cost over time. And what I'm saying is, I do think that we've overdone it here in terms of the expectation of how much hiking we're going to get in this cycle. And that very likely, 6 to 9 months from now, we could have a much different outlook in terms of how much more hiking or how, if any hiking is going to continue at that point. And that's when I think things like bonds, which have sold off sharply, year to date, we've had this really big reversal in treasury bonds, even more than in corporate debt, which is really something when you think about the dynamics I'm describing here. But we've had this big sell-off in the treasury market, about 11% total return, negative return since January. And that is up there with about the worst bear market you get in treasury bonds historically. It's about as bad as we saw in the 2008 recession as that began. But then ultimately what happens is you get into that downturn in the economy, things start to implode on the demand side. These asset bubbles start to break, and you get this rush back to the liquidity and relative safety of things like treasury bonds as equities and corporate debt, commodities, everything kind of roll back over. And so I think we're likely to get that resurgence back into the treasury bond market again in the months ahead. And that should bring the whole mortgage rate structure back down again, because again, they're tied directly to those treasury yields. So I don't think we're going to see a sustained period of 4.5-5% mortgages, as some people are currently predicting. The trouble is that even getting from here to there is going to be difficult for people that are highly levered, right? Yeah. When you see the amount of increase that's already happened, not just in prices, but in rents and in the carrying costs, I think that there's already a good deal of strife that's happening right now.
I agree. Now, so based on what you shared, what does your portfolio look like right now? How are you set up, Danielle?
Yeah, so we actually have taken the opportunity of the sell-off in the last month to add some longer dated government bonds, Canadian government bonds. Again, because yields have come up, and wherever we had the room to do so, we've been adding some of that. We have maintained a good cash position in here. We have avoided, we've avoided the consumer staples and consumer discretionary sectors of the economy because they are equities. And you get this relative talk a lot in these environments, Jay, where because most funds and managers have a mandate to be fully invested at all times. Right. So coming into a downturn, they will say, okay, so you come out of cyclicals and you go into consumer staples and defensives and maybe emerging markets. Like you hear people trying to, move chairs around on the deck of the Titanic, I like to say, but ultimately those things all don't perform well in this environment. And we've seen that, in fact, you've already got housing, the home building stocks, the furniture companies, the autos, like anything to do with the consumer home buyer sector of the economy has already rolled over sharply, down about 20% from the highs. You've got the auto sector also rolling over for the same reason. This is all directly related to the credit sector. You're also seeing a rollover in services now, Jay, because of what I've described about how these, the surveys are already showing consumers are under great strife here with their cash flow and negative real wage growth over the last few years. So there's really not a lot of safe pockets to hide in terms of equities. Now, for anyone that feels they have to be fully invested, yes, they can try moving to things like some of the consumer staples, but that doesn't mean they don't go down in these periods following a big inflationary spike. And I think that, that's playing out right now as well. Also, it's very important to keep in mind that late cycle performers, the reason the TSX, for example, is held up longer than the S&P and the NASDAQ and that sort of thing, is very traditional of what it normally does in these peak periods because of our heavy weight in, of course, fossil fuels and banks, right?
Right.
But unfortunately, in the environment I'm describing, fossil fuels and banks are the next to get hit. Coming out of this, peak demand, disinflationary, over expectation on the tightening side, and then you start to see inflation expectations come down again as commodity prices fall into the second quarter. And so I think that you're likely going to see more pressure on banks because guess what we've got today, Jay? We've got basically a completely flat yield curve between the 10 and 2-year yield spread. That's come down from about 1.69 just a year ago. So we've had this rapid inversion happening in all the yield spread curves in the bond market. And that, again, puts great pressure on financial companies, right, who make money on the spread.
Yeah.
And at the same time, you've got asset managers starting to come under strife as well. So all these things are, tricky because we've all been sort of infected. All these sectors have been infected and inflated by this monetary largesse and fiscal largesse over the past couple of years. So everything that basically went up together is now at great risk of coming down together all at the same time. So that's why it's very difficult to find negatively correlated positions to be here.
Sure.
But our particular choice has been, we did have, for example, ETFs in our portfolio a couple of years ago. We came out of those because of our concern about this contagion. Because there's no fixed maturity dates, because there's no contractually prescribed income payments that have to flow off of things like equities, things like ETFs, things like mutual funds, these things that people are in, basically there's no due date to get back any money. So we moved into things like bonds with a set maturity date, a set coupon payment, on the very idea that, yes, you can have an interim fluctuation or downturn in the price of those assets, but it's a fraction of what you're likely to see in any of these other, non-prescribed, non-guaranteed instruments. And also, when the liquidation really begins in earnest in these other things, it's where you typically see money repatriate back to, as I say, the government bond side. And that's where you get inflows that reflate those prices again. And then at some point there, and I'm hoping that it'll be within the next year or so, you're going to get an opportunity to then sell some of that longer dated government bonds. Even you don't have to hold them to maturity. They are liquid. You can sell them and move some of that capital into these other, like the corporate debt sector, which by then should be yielding about twice what it is today, potentially more. I mean, we've already seen, corporate debt sell off, as I said, about 6% year to date or so. And the yields have therefore come up significantly, but they could still double over the next little while as this repricing happens. And then it'll be an opportunity to put money back to work on the corporate debt side, but also on the equity side. And ultimately, all the sectors tend to bottom together in the end. They start sort of into the cascade at different rates of change. But ultimately, it's always the same. The ones that were the most overvalued, the most overbought, the most widely loved, the tech stuff, as we've seen, the Russell 3000 is, still off significantly in a bear market. And most of the stocks in the NASDAQ have come off more than 30%. It's still the Apple. Apple is still the apple of everybody's eye right now. It's still 7% of the S&P, still, some 12% of the NASDAQ. It's the most concentrated company that we've seen in those indices for decades and decades. And although it was beginning to roll over coming into this month, in the rally of the last couple of weeks, we've seen a big rebound. We've seen the S&P jump 10% again. I think this is all bear market rally stuff.
Okay.
And far from an opportunity to move back in, unless you're trying to do a day-to-day, week-to-week trading sort of approach. If you're sort of trying to do a more long-term investment thesis, I think there's significantly more downside here, like in the order of 50% plus. And that will really be the optionality opportunity for any cash you can, right, keep out of harm's way between now and then.
It's everything you're saying is consistent with a lot of like the quote unquote smart money that I pay a lot of attention to and have on the show. It's this de-risking strategy that I've seen over the last 12 months. Right. And I first started noticing this when I had Grant Williams on, and he's like, just FYI, this is maybe a year ago. He's like, behind the scenes, everybody I'm talking to who I respect, and this is some, so he's like, they're all taking cash off the table. This is a massive de-risking play occurring right now. And this speculative run in the equities market could continue for another year. Who knows? But most of us don't care. That was the words from his mouth. And, it's aligned that you're positioned in Canadian bonds and cash. I've been struggling, therefore, to answer a question, Danielle, where is their value, right? Like, one of the reasons I do this show is to make myself a more sophisticated investor. And that's the core reason, to be honest with you. And then to improve my portfolio's performance. I can steal ideas from you, from Grant, from whoever, and then try to build my portfolio based off of what I learned from these conversations. It's been a really hard question to answer. Where should you allocate capital right now? Where is their value, right? Because across the market, it's all-time highs everywhere, right? Equities, real estate, cryptocurrencies, no matter what. And, one area that I've been looking recently, just from a sort of curiosity standpoint, has been agriculture. And, I wrote a little bit about this in a couple of my recent newsletters. I've been looking at these land packages zoned agricultural land reserve, because on a per acre basis, they're priced at like 10 to 15 times cheaper than a traditional land package that's open to development. Now, the reason is you can't subdivide and build and sell. But there's just a plethora of really attractively located land packages all across British Columbia, where I live. And I'm curious about what could be done there. But, so I'm looking at agricultural land. I've kind of been looking at these, just exploring like alternative asset classes, even like art and whatnot. But, outside of traditional bond cash, are you curious about any industries or alternative asset classes right now? Is anything catching your eye?
Yes, I'm very curious about them, but I'm also very aware of three main trends that are unfolding at the same time. And I think they are defining of our generation. And I think maybe you're aware of the Rethinks work, the Tony Seba and James Arbush. But basically, they're looking at this generational transformation that's happening, disruption they call it, in energy, transportation, and agriculture all at the same time. And the reason that it's happening all at the same time, as they explain in their work, is that it's this convergence of technology has enabled this rapid transition, which they say will bankrupt some of the legacy sectors and industries by 2030. So this is all real time for us. This is not, pie in the sky decades away. This is happening right now as we speak. And that is, I think, going to impact greatly things like agriculture and land use. If you look at, so for example, the idea of precision fermentation, I've been a vegan for many years for environmental and health reasons, but there is a huge awareness right now of the fact that you can actually manufacture, whether you want to eat cheese, milk, meats, whatever it is, you don't have to prescribe to any kind of vegan ideology. If you want to have less of an impact on the planet in terms of the devastation to water and more efficient resources, there's companies who are developing ways to actually just create things like the proteins in meat, the heme, or the 0.3 proteins that make milks, and then you add water and you've got milk. So to disrupt this industry, as Rethinks points out, you don't need to replace all the cows and all the milk production. You just need to be able to create in a lab somewhere or manufacture this 3% that actually defines that product once you add water and stir. So I think that's already happening, right? And there was a really good documentary that came out recently on Dairyland on the transition that's happening in the dairy industry in New Zealand, which I put on my blog this week, because it's also very eye-opening, right? Dairy being the largest export for New Zealand, Fonterra being the largest company, the biggest employer, all that stuff. And when you look at the actual underpinnings of that business, they're already in a losing money scenario and have been for some time. And when you realize that the government actually looked at, and so did big business, looked at this idea of, holy cow, maybe the puck's moving over here. Maybe we do need to look at more plant-based agriculture instead of this really highly inefficient system. They realized that they'd already polluted their water supply to such an extent that transitioning to this, because clean water is actually the most valuable commodity, right? We've had this exchange on Twitter, Jay, where people will say, what's the most valuable asset? And you and I both agree it's health, right?
Yeah.
But what's the most valuable commodity? It's actually fresh, clean water.
Sure.
Why? Because it's the building block of everything else that we do. So my fundamental criticism with things like the oil sands and all this over the years has been taking barrels and barrels of the most valuable resource and spending it, polluting it to create this other resource, which can actually be exchanged for other things, which can be replaced and is being replaced. So I know there's this great, clinging to the old legacy ideas and sectors, but I think as progressive people that are on a rock spinning through outer space right as we speak, Jay. So I always like to say to people, what about this system makes you think that things should be stable or constant or the same? We're constantly changing, right? And disruption is the norm, not the exception. And what SEBA's work and they point out is that it's an S-curve adoption. So it always looks like it's starting slow at the periphery and then it blasts through everybody's expectation of how quickly this convergence happens. So I think that I don't know enough about where we're going to be in terms of this transition, like what exactly we're going to be using land for. But it looks to me, based on these projections, which have been incredibly consistent, again, not because they're clairvoyant, but because they use this S-curve analysis and assessment of all these major transitions that have happened over centuries of human experience. When we moved from the horse to the ice engine, and all this has been very typical of these transitions. So what you see is that the legacy industries don't see it coming. They pretend to extend. They get subsidies from governments to try and prop things up as long as possible. And then ultimately, for financial reasons, the change happens and everything else basically breaks and we go on to the next thing. And I think that's figuring out where those themes are going right now is the most important thing. There's a lot of high risk opportunity for individual companies. People can put in venture and all that. It's there, we know mathematically 80 or 90% of those won't succeed, but this transition will. So it's trying to be sort of aware of that in terms of not making, classic allocations with these old world backward looking views and trying to be, control your risk exposure so that you're not, because again, this is a highly volatile scenario where a lot of things will fail in this transition. So trying to keep your risk tolerance in line with your, lifespan so that you're not just throwing all your money away. So it's very difficult and tricky. I agree. But I think that most of all, I think the future is very exciting once we accept and adopt and move into these things. The part that has to correct itself, and this is why this is a massive rate shock that's happening in the world on top of food and energy. I get it, but it's essential because we need to burst the bubbles that are impeding us from going on to this next investment environment. We need to reallocate people's behaviors and decisions away from rampant speculation and thinking that driving up the price of housing 50% in 2 years is progress. It's not progress. It's the opposite of progress because it's still just a shelter. And it isn't any more efficient. It's less efficient. And now we've got to spend all this much more money instead of on innovation and transition. We're just putting it into consumption. So there's a lot of opportunity here, but I think we need to really let this busting session, which I think is underway now, run its course. Try and sort of take shelter as much as you can. And you do that by reducing your leverage to as low as possible in this environment, building up your cash, living within your means, keeping your budget, don't lose your banana. Don't be a Will Smith and snap, right? Keep your discipline about you. Keep your process and know what it is you're trying to accomplish and where you're trying to go and what the risks are right now. And I think this urgency to do something. We want to do something. This is this is the bane of all good decision making, because ultimately it's not about you can chart the course. You can look at where you think things are heading. You can do things from a micro, personal balance sheet up management perspective, but that doesn't mean the opportunity is going to be here today just because you happen to have $5,000.
Totally.
You really have to be very constrained, and I think that's the problem with our current. I noticed today Robinhood is going to extend its trading for retail people because Robinhood's market share has tanked, their shares have tanked, their business models tanked because they were all about this speculative bubble. So all these things that were the poster children for the speculative bubble are imploding. And I think that's a very healthy move. We need to have that. I don't mean I like to see people get hurt, but it's essential that we get this righting of the ship, so to speak. And so all that obsession with click, 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 what can we do today? I'm trading right here. That means I'm making wise financial decisions. That's the opposite usually of what people can do constructively. So, it can be very distracting from larger goals and activities.
Yeah. You know what you've got me thinking about right now is, I guess, my personal strategy over the next 8 years, call it the remainder of the 2020s. And I see this as sort of like the 2020s will probably be how the 2020s have been, right? For the next chaos, right? Like unpredictable, unprecedented events in continuum. I don't really see the world calming down. We could talk about, we've talked about why, if we thought that, protests and demonstrations over masks and shelter in place mandates were passionate, just wait until there's riots over food and fuel and housing. Those are far more significant. So recently I've been approached with a couple opportunities to scale my business, and it kind of looks like, you could acquire some other YouTube channels and podcasts and build a bit of a network. And obviously the entrepreneur in me is fired up by that. And I want to explore these opportunities simultaneously based on what I just said about my expectation of just increased volatility for the next years. I keep on coming back to a place of, the best asset in my business right now is going to be agility, right? Agility and simplicity. And I don't know what the next 3-4 years are going to look like. So what do I want my business to be? Agile, adaptable, right? And honestly, small. I mean, that's kind of where I come back to. It's now's not the time to scale something. Now's the time to be incredibly specialized or just keep it lean, keep it smart, keep it minimal, right? And that's where I keep coming back to. And that gives me this peace of mind where it's that's how I navigated 2020. As you know, I was 95% event production revenue until COVID hit. And then I woke up on, April of 2020, was what do I do for a living? I got no idea. Right. And so the reason we survived was because we were able to peel back all of the layers, get to our, really just the smallest enterprise possible, and then be super agile and figure out the new plan. But agility was the asset. I mean, without question.
Yeah, absolutely. And I think, if you go back to macro, because we all tend to be very fixated on micro in our own, experience, our own business, our own sector, our own household. And that's all where you should start in terms of foundational, sort of fitness training. But if we pull out the macro conditions that I've been describing, the most fiscal largesse of our generation, the lowest and most, the loosest financial conditions in monetary policy of our generation. There was something like 16 trillion of negative yielding debt in the world, which made no sense at all. But that's because they pushed rates so low that, people were just looking for anywhere to put money. So that thesis, looking for anywhere to put money, has been really like the slogan of the last 2 years. Yeah. And I see it now because we've got a lot of, venture capital or hedge funds or, alternative investment pools. Again, talk about something that has been a pandemic, the inflow of money looking for anything at all to do with very little discipline or very little actual opportunity. Because if it was really strict on its discipline in terms of what it was prepared to buy at what price on what thesis, it wouldn't be buying much in this environment. But truthfully, everyone lowered their standards just because money was coming in like a fire hose. It's like, oh, well, we got to put it somewhere. So we might as well put it. So what I've noticed is that if you have an opportunity, for example, for someone comes to you right now and says, hey, we'll give you a boatload of money for your business, I'd say maybe take that. But if they're coming to you and saying, hey, we'd like to get you to give us a boatload of money for something, that's when I think you might go, no, I think I'm going to stay, like you just said, I'm going to stay nimble. I'm going to stay low leverage in this environment because I think better opportunities are coming. And I think that, again, it's amazing. I remember after the crash of 2000 and, the implosion of 2008, people saying, but where did the money go? I don't get it. Like, where did the money go? And the thing is that there's this, not everybody is long risk assets here. There are people that haven't lost their mind, who do have investment discipline, who have built up cash, who do know what they're looking for in terms of what is a compelling investment multiple or interest for them, but their strike price is much below where the current offer is, right? And so it looks like everybody's, just, oh, well, you just buy because you have money and no one really pays attention to valuations anymore. That's not true, right? That's the media, that's the financial business. That's what they're telling people to get people to part with their cash at all times. The reality is there's a lot of people that do have a discipline and are looking at the math going, it doesn't make any sense here on any level. None of this makes mathematical sense or investment sense. So I'm not just going to throw money around like a drunken sailor. I'm going to actually just bide my time, because I believe that historically there has always been a period where we go into a diametrically imposed environment where everyone that wasn't disciplined learns the hard way why they needed to be, and why those that have got through the environment and prepared for it really get these incredible opportunities. So I think you're exactly right to manage it, keep your overhead low, keep nimble, keep moving forward, keep looking for opportunities. But also just to second guess the consensus view, because I really do think the consensus view has been drinking its own Kool-Aid, has got really, high on the fumes here. Yeah. And unfortunately, the industry, I've mentioned this before, but my greatest complaint about the finance industry is that it is very much compensated by transactions and by getting people to buy things every day in every way. Yeah. Not about risk management. Most don't hold cash because if they hold cash in any portfolio, they don't get fees on it. Yeah. So that tells you a lot about 100%. why there's very little people holding cash, even at the highest valuations and the most crazy monetary conditions in our entire history.
Yeah, well, you're right. It's really important to understand the incentive structures, right? That often dictates why things occur the way they do. To your point, I sit on the board of this organization called the Entrepreneur Organization, and it's a global org of entrepreneurs. Vancouver chapter that I'm the president of is 172 business owners. There's been more transactions in the last 8 months. That's more small to medium businesses purchased, is what I mean, in the last 8 months in this organization than I've seen in the previous 4 or 5 years. It's just been the money's still sloshing around, right? And
so a lot of the people that I've spoken to who have been bought out in those exact exercises, many of them are like, optometrists or dentists or various professional groups have been part of this, pharmacies, all that sort of thing. Many of them will say to you, I've been in the business 30, 40 years, and I don't understand the price they're offering but I took it.
Good.
Right? Like I've literally operated this business for 30 or 40 years, and the multiple they just paid me for the revenue stream or the income doesn't make any sense to me. And then they think, oh, well, but maybe I'm just missing something, or maybe I'm old school. So very often they're taking that offer. Great. Take that money. Now, here's the problem. A lot of them, and this is classic, they then are incented to turn around and give that principal back to that same investment consortium. So they'll say, this is like, this is classic for, Wall Street, who helps a company go public. And so they make all the founders and executives wealthy because they sell the shares to the public, right? And then all of a sudden, this is a liquidity event, a cash out event for the founders, and they're gazillionaires. And then Wall Street turns around and says, now, give us that money back and we'll manage it for you. Then they turn around and give that, spend it on all these overvalued businesses again. So if you're really smart, what you do is you take the offer, but you don't leave a lot of cash on the table with them, because you're saying, remember, the math didn't make sense to you, who knows this business intimately, who has operated it for that many years, and someone's prepared to pay you X. You don't understand how that makes sense, because it doesn't bloody make sense. That's probably why, right? It doesn't make sense. What it is free money flowing. Now, so if you can get that cash and not part with it again and not giving it back, putting it back into harm's way, that's a really good strategy in this environment.
Last question for you, Danielle. Do you have any thoughts on, the crypto market is a market that hasn't ever existed in a high rate environment, right? This is a test that hasn't been put through yet. And I'm really curious, even if we don't ever really get to a high rate environment because of some of the things we discussed, but where do you stand on that market? Are you positioned? Are you watching from a distance? Any thoughts?
I've spent a good deal of time in the past decade, let's say, doing some in-depth research, going back and thinking, okay, well, maybe I'm wrong. Challenge your status quo view and all that. I do think it is most correlated with this environment that I've spoke of, being this decade of unprecedented monetary largesse. So this exceptional period of speculation that's been backstopped by central banks pumping money and rates at nothing and inflating debt. And I don't think that it makes sense as an asset class. I mean, again, blockchain aside and all that, I don't think it's an asset, an investable asset. I think it is a token. I think it is a chip at the casino, so to speak, and that you can win if you have a strategy. And some people have devised, cryptocurrency trading systems and that sort of thing. I do think you have to be careful, though, because when the music stops and the chairs are gone, I'm not sure that you're going to have much of a seat in cryptocurrencies either. I think they've become highly correlated with this risk compulsion that I'm speaking of. And if we go back to this worldview where things like clean water is actually the most valuable asset, food, energy, then I see cryptocurrency as the antithesis of those things. It's highly energy intensive. Is not anything that you're going to be able to consume to sustain life. I just don't think it is the correct emblem or token or embodiment of the value system or the resources that are going to be most highly valued in this next decade and as we move forward. So I just, I'm not saying you can't trade it or you can't use it in some way. I'm not, I understand people have different approaches. I do worry about people who sort of hook, line, and sinker. And we are susceptible, Jay, to it's a mental illness almost. It's dangerous, where any particular thesis can really grab us, and we start to become super convinced in that one thesis, and we tend to over allocate that at the expense of other intelligent decisions that we should be doing. So I do see it as dangerous. It's a casino style risk, and as I say, I don't know that it's going to fare well in the environment that I'm speaking about.
Right. Yeah. Okay. Very interesting. Look, this has been super valuable because it's just kind of bolstered my tempered enthusiasm and I guess forced me to continue to question, because I follow it, the same as you said it, right? When you have cash recently, it's been the number one urge has been, where can I allocate this money to, right? Because everything's going up in price. And obviously I want to seat on that train. Of course I do.
Yeah.
And I've been working very hard to temper that enthusiasm over the last year, following conversations like this. And I think that's why this is super valuable. So I appreciate you sharing your perspective with myself and my audience.
Thanks. I always say, don't ever forget how the tortoise wins the race, right? It's not about being the hare. It's a long-term cycle. It really is.
100%. All right. Thanks again, Danielle.
Thanks, Jay.
All right, thank you for watching this interview. Now, 3 things before I let you go. Number 1, I publish a weekly newsletter and I love writing it. I share my biggest takeaways and action items from the conversations that I have on this channel. In addition, my thoughts on current events, economic events, political events, and you can subscribe for free. Just hit the pinned comment right beneath this video, or just go to jmartin.club and you can subscribe on the website. I'd love to have you join the team. Number 2, ad revenue from this channel is donated to an organization that is super close to my heart called Zero Ceiling. Now, Zero Ceiling's mission is to end youth homelessness. And the way they do this is by giving at-risk urban youth the opportunity to relocate to beautiful wilderness areas and then provide them with supportive housing, career training, and just generally positive influences on their life. I love what they do. Check them out if you're interested. And number 3, if you prefer to listen to my content as opposed to watch it, you can find me wherever you listen to your podcasts. Just search for The Jay Martin Show. All right, thanks again.